My name is Wendy Powers, and I am a loan officer with Prime Lending. The video series that I'm going to be doing is on first-time homebuyers. So this will be an educational series that helps you know if now is the right time to buy your first home. Owning a home comes with a lot of benefits compared to renting. Renting doesn't come close to the privacy, space, and freedom that comes with owning a home. And we're here to help it make it possible for you. We make each step of the way as simple as possible and as hassle-free as we can. No games, no gimmicks, just results getting you into your first home. So sometimes people think that renting is just easier, and so why should you stop renting? And what I'll tell you is that renting is usually, not always, is less expensive than, having a mortgage is less expensive than renting. So keep in mind, I will probably stutter over my words, I'll probably say things wrong, but that's who I am. So owning a home always allows you to build equity, whereas renting, you're basically just throwing money away. And a lot of times when you're renting, you can't even save money for a down payment. It's very difficult. So we're going to talk about a lot of different options that come with getting a mortgage, as well as down payment assistance programs if you qualify, to help you with getting that money saved that you need. And owning your own home, you make the rules, not some landlord. So that is a really nice feature. So first thing you usually want to do is, research, do a little bit of research, determine that you have a knowledgeable loan officer, someone who knows about the process, someone who's been in the business. For myself, I've been in the business now for 13 years, and first-time home buyers are my favorite because sometimes I'm learning something new as well. Maybe it's a new product that and I say product, but I do mean loan options. We have over 400 different options, and with my experience and my knowledge, I'm going to help make it as simple as possible. And again, these videos should help you with being prepared when you're ready to get started. So what we're going to do is talk about some basic mortgage things, like how much do you qualify for, what does your credit score need to be, how do I know if I'm ready? So we're going to start today with a little bit on your income. So with income, we do need to know what your income is, and as weird as it may seem, a lot of people don't know exactly what their income is. So if you are a W-2 employee who's paid hourly, you probably know what your hourly rate is, and hopefully you're getting overtime and bonuses. But if you're not, we do go by your gross income, and we do calculate it monthly based on your pay stubs. As long as your pay stubs do need to have a year-to-date number on it. And then we'll look at the last 2 years' W-2s. So with those numbers, we're able to calculate what your monthly income is. That's important because we do look at debt versus income. So we take a look at how much income you have. We also factor in what debts do you have. So do you have, and these are debts that are on your credit report, as well as any debts that you do pay monthly, whether that's alimony or child support. And we do need to know about all of it. So that is some of the questions that we're going to ask you. What is your monthly income? We're going to ask, do you typically work 40 hours a week if you're hourly? We're going to want to know, are you paid monthly? Are you paid semi-monthly? Are you paid bi-weekly? Or are you paid weekly? So we do look at how often you're paid as well. So those are some questions that you're going to be asked. If you receive bonus and overtime, then we are going to need to know on average what it is over the last 2 years. So if you've only received it for 6 months, we're not going to be able to count it. So that's important as well. Now, if you are a commissioned employee, so let's say you work at a car dealership and you get an hourly rate, plus you get commissions. We are going to look and see what those 2 years commissions are that you've received, not what you're going to receive in the next 6 months, what you've already received. So that can be, if you receive more than 25% of your income in commissions, then we will need to see 2 years tax returns. The reason for that is we are looking to see, do you write off employee expenses that aren't reimbursed by that company? If you are a self-employed borrower, no worries, as long as you have 2 years in the same industry, and we can look at those 2 years tax returns. We do go by what your income tax income was, as well as we look at what you write off. So do be aware that we will need to see every single page, every single schedule that is on your tax return if you're self-employed. And again, it's got to be 2 years. So then we're going to look at those debts. So let's say you have a car, a student loan, but the student loan's in deferment, and you have credit cards. We are going to look at those debts and determine, are you going to still have those 10 months from now? If you're not, so you're ready to pay off your car in the next 3 months, then we don't have to count that debt against you. If you have student loans that are deferred, that's a whole different story, because we do have to, on certain programs, figure out what that payment's going to be when you come out of deferment. If you are on income-based deferment or income-based payments for your student loans, we need to see something in writing that shows us what that income-based is, and if it's going to continue for the next 12 months based on an income-based. So student loans can be a little tricky, and so that is a situation where we'll need to talk a lot more about what those student loans are. With your credit history, so we do take a look at a person's credit score, and we do determine, do you have 3 trade lines? Do you have 3 credit scores? And we also look at the history. So have you had collections in the past 2 years? Have you had anything charged off? Have you had a bankruptcy or a foreclosure? So we are going to ask a lot of personal questions, but be aware, we're not going to ask for anything we don't need. So sometimes I've had customers in the past who are like, you want my first child now. The truth is we won't ask you anything that we don't need to know. And we don't remember, later anything about that situation. But while we're in the process, we're going to ask you a lot of questions. There's going to be some documentation that will be needed. But as far as credit goes, we've heard it all. Don't be embarrassed. Sometimes we're surprised and your credit's better. Sometimes we're surprised and it's not as good as you thought. But we do offer programs to help a person rebuild their credit in a rather short time period so that you can be in the position to buy a home. Even if it's not now, it could be 90 to 120 days later. It could be a year later. It really just depends. Now, what if you're the person who doesn't have any credit? You just have never done it. You've always believed in paying cash. That is what we call non-traditional credit. So we do offer programs that allow you to purchase a home even if you have no credit. What we do is at that point we say, okay, have you paid rent for the last 12 months on time? And you say yes. Okay, great. We would need your landlord information, and we actually upload this to our credit bureau department, and they will count that as a trade line. We would also need 2 more. So if there's 2 of you on a loan, neither one of you have credit, that means you each need to have 3 non-traditional credit sources that you've paid on time for the last 12 months. Non-traditional credit consists of utility bills. It could be something like Netflix. It could be a gym membership. It could actually be a medical bill that you've been making payments on, maybe braces that you've made payments on for 12 months. So we do work with you to try to figure out how to build that non-traditional credit. So, if that's your situation, still do not be afraid to come and talk to us. Part of our job, we want to be your trusted advisor. We want to assist you in getting you to where you need to be able to purchase a home. And we've heard it all. So again, there's no worries here. Don't be stressed about it. It should not be one of those situations where you're embarrassed to come talk to us because you don't know anything about all of it. Hopefully these videos that I'm going to do, which will go into quite a bit more detail on each subject so that you feel comfortable talking to me. And then the other things we're going to ask about is, excuse me, my computer monitor just went off. We're going to talk about assets. So assets would be cash that is not at home under your bed. If it is under your bed, we're going to recommend that you go make a deposit into the bank, because we need to show 2 months of money being in a bank account without having to ask you where did that cash come from. It would be savings accounts, checking accounts, money markets. It could be stocks, it could be bonds, it could be mutual funds. It could even be a cash life insurance policy that you're able to cash out. So we do look at the whole picture, not just what do you have in your checking. We're looking to see what all of your assets are, and retirement accounts are a great way to purchase your first home as well if you have money in a retirement account. So when we look at all of those, that's how we're able to tell you how much home you could afford to purchase. That always raises a lot of questions as well. The bank might say you can afford much more than you're willing to spend, and that's great. We want to keep that debt versus income ratio that I had mentioned earlier. We want to keep that as, pretty low. So we do have numbers that we can't go over, but we do explain all of that to you. Sometimes I have customers who say, I just don't want my payment to be more than $1,200. So then we can work backwards and tell you exactly what purchase price you could afford. So let's say you're just a little bit high on the debt to income ratio. You also have the option of adding a co-borrower. We have done some loans recently where the borrower didn't have any documentable income because they were self-employed for less than 2 years. But their parents had plenty of income and were willing to co-sign because they knew that their child was able to make the payment and they didn't feel that risk. So we will sometimes make recommendations like that. One of the other things that I think is a little bit of a myth that people thought that you only could purchase a home with 20% down. And that is not true. We do have programs that are no money down. We have programs where you can put as little as 3% down. So, if you qualify for those programs, we do offer those as well. And then we have down payment assistance programs, which are through North Carolina Housing Finance Authority. So that is where they will cover 3%, 5%, and sometimes, there's different dollar amounts of what you can use for down payment assistance, and it will even help with closing costs. So we do offer a wide variety of products. So those are some of the things that I think that most people are interested in as far as how do I even figure it out? How do I get started? So let's talk a little bit more about closing costs. So closing costs consist of lender fees, so what the bank is charging to do the loan. There's third-party fees, which would include getting an appraisal, which goes through someone else, but we do collect that. The attorney fees, because you do use an attorney to close on the loan. What attorneys do typically is they make sure that that person who's selling the home is able to sell the home. They check to see if the title is clear. So title, again, is where they check to make sure that the owner of the home is who they say they are and there's no restrictions. They'll also look to see if there's easements. For an example, an easement for the electric company to be able to come onto the property and get to a electrical pole, I guess. Some easements can be, especially here in North Carolina, some easements can be for shared wells. Maybe you and a neighbor share a well for the two homes, so there would be easements for that. Maybe you live on a gravel road or looking at a home that's going to be on a gravel road, and there would be easements for driveways. Maybe there's a shared driveway. So there is a lot of things that the attorneys actually do in that situation. And then there's something called prepaid costs. These are typically collected for taxes and insurance, and that's so that every year when these two items become due, the money is in an account in your, for you, that goes and pays taxes and insurance when they're due. So it is part of the payment. So credit scores. Again, these are just high touches, and then I'll go deeper in other videos into a lot more detail. We'll do that, dig deep. So how does my credit factor into a loan? So credit reports are based the scores are based on the history of your past payments, if you paid them on time, and this helps us determine how likely you are going to make your mortgage payment. Your credit score, also known as a FICO score, can factor into the different types of loans you're eligible for, because if you have, as an example, a 580 credit score, we can only do an FHA loan, which is Federal Housing Authority loan. If you have a 620 or above, you're opened up to a lot more mortgage options. So this credit score does affect your interest rate, it affects your down payment, and it affects your loan amount. So if someone comes in and they have, the 580 credit score as an example, you may have to put down more money than someone who has a 620 credit score. So again, it really depends. If you're looking at a loan that's over $417,000, that's considered a jumbo loan, and you would be required to put down more money, but also you may be required to put down more money, but you also have to have a 720 to get a loan that is a larger loan amount. So a lot of different factors that go into every single piece that we look at. The next thing is what consists in a mortgage payment. So a lot of people, they'll tell me, I want my mortgage payment to be no more than $1,200. When we look at that payment, I know that I have to back out some money, probably about, $250, $300, and then figure out what amount loan you could get, because your principal on your loan plus interest, taxes, and insurance are all part of your full mortgage payment. An additional part to your mortgage payment could be private mortgage insurance. Private mortgage insurance is required on any loan that you put down less than 20%. This is an insurance policy, if you will, where it protects the lender in case you default on the loan, but you do pay that fee. So when I say that that's part of the payment, I will explain that mortgage insurance, private mortgage insurance, there are so many different ways you can do it. You can do it so the lender pays it and you maybe have a little bit higher of an interest rate. There are ways that your seller could give you funds towards your closing costs, and we can use that to pay a single premium mortgage insurance so that you're not paying a monthly amount. And then there's what we call splits, where it can be half part of your down payment and half part of your monthly payment. Mortgage insurance is not a horrible thing, mostly because there's so many different options of how we can do it. So I wouldn't get too worried about that. Okay, so then APR. So this is a big thing. Interest rates on loans are determined by so many different factors. So it's determined by how much money you put down. It's determined by what your credit score is. It's determined by the loan amount. I mean, as crazy as it sounds, if you have a $40,000 loan versus a $175,000 loan, your rates are going to be different. So there are steps and there's adjustments, is what we say. So there's adjustments to the type of loan, interest rate. So if you are buying a primary residence, you're going to have a better interest rate than someone who is buying an investment property. And then this is now where we're at with the APR. Annual percentage rate is a measurement to help buyers compare mortgage options. So each bank can be a little bit different. They could have a rate of, let's just say 5%, but your costs for doing that loan may be high. And so APR, annual percentage rate, takes and measures what you're borrowing over a 30-year time period, and then tells you annually what that rate would be. Whereas your interest rate is just the interest you're paying on that loan amount that you're borrowing. So you have to have both. If a bank gives you a good faith estimate, or you're looking at a website and you're trying to figure out how does prime lending compare to movement mortgage or prime lending to Quicken loans, the only way we compare them is by the APR. So an example would be 5.25% interest rate, but the APR is 6.25. That's a 1% difference. So they may have really high payments. But if you go to a bank and the interest rate is 5.375, but your APR is only 5.875, you know you're not paying a whole lot of fees, and it may in fact be a better loan for you. So to be able to compare apples to apples, you have to know what the APR is, the annual percentage rate. Again, we'll go into more detail. That's just a quick, make sure you're comparing loans to loans. The other thing that's really difficult with comparing is if you do not own a property, you cannot lock in an interest rate unless you do a special program, which we offer one called Lock and Shop, which is where we lock the rate for 90 days and you go find a house quickly. So when you call up and just say, what's the rate, you're not going to really get a great answer, because if they don't know what your credit score is and they don't know, how much your down payment's going to be, and you don't even have a house picked out yet, it's going to be difficult. Rate is not the most important thing at that point. Rate becomes more important once you found a house and you're ready to actually lock in that rate to that property. So that's a point also, is that rates go with the property, not the person. So if it falls out, you do a home inspection and realize it's not the house you want after all, the rate will not be the same when you find the next home. I mean, I hope it is, but we don't know. Rates do change daily, and they're subject to change throughout the day, depending on the market, what's going on with the 10-year Treasury note. So one other thing to keep in mind, and it kind of goes along with what I was just saying, is that being approved, pre-approved, and pre-qualified are where you have actually given the bank your pay stubs, your W-2s, your asset statements, and they have said and sent this file to an underwriter, and the underwriter says, yep, I'm ready to go, then you can go and purchase a home the very next day if you want, put an offer on it, and then all we have to do at that point is your appraisal and get your title work done. So it is a very good way in a market like Asheville to kind of be in competition with someone else who maybe isn't approved yet. You have more buying power. So keep that in mind. You do definitely want to talk to a lender before you pick out a house. It keeps you from being disappointed in the long run if for some reason you're not ready to move forward based on credit. So home loan options, and again, this will just be quick. Conventional financing is loans up to $453,100. I apologize, I said 417. That's an old number. So that is a conventional financing. The FHA financing, which is through Federal Housing Administration, this is a government loan, and they provide their own mortgage insurance on it. So that's kind of nice. The down payment on that can be as little as 3.5%. They typically do have lower interest rates, and it is something that is great for people who have lower credit scores and need down payment assistance. So it is a good loan. We also do the VA loans. So these are U.S. Department of Veterans Affairs. These are for veterans, and the veteran does have to be the primary borrower on the loan. And these are amazingly good loans. There is no down payment required, and there's discounts. So if you are a disabled veteran, you save a lot of money on a funding fee that the VA requires. So VA is a wonderful loan, and there's no maximum loan amount, so we don't have to worry. If you can afford $1 million loan, great, we could still do that. We also have those jumbo loans that I was telling you about. That's for a loan that is over $453,000. And then my favorite is the renovation loan. This is for people who found a home, but maybe they need or want new appliances. Maybe you want to add a pool. Maybe you want to just redo some stuff. You found the perfect house. Not really. You're never going to find the perfect house. You might, but typically every house, there's going to be something that you need to, maybe 10% is not perfect. And this is the best way to be able to get the house the way you want. And it's all rolled into one loan. It's a very popular loan at this time. You could also use this loan for those foreclosed properties that no one else can buy. And you can do whatever you want. You can gut the home if you want it, as long as you keep the initial footprint of the home. So renovation financing is wonderful. We can do that for refinances as well. So the first thing you need to do is give me a call. What's nice is I do a lot with technology, so feel free to look me up on all the different social media sites. But even on my own website, you can fill out an application to get yourself started to see what are the next steps. Remember that applications do ask a lot of information, so be prepared. And my website is www.myhomeloanpowers.com. So I look forward to talking to you and getting you on the path to home ownership. And please watch for all my other videos that will be coming out in more detail about being a home buyer. Please like and subscribe, and I look forward to talking to you soon. Thanks. Bye.